Look at your gold chart right now. We have a $250 daily range today, from 4,629 down to 4,500, and we just bounced back to 4,523. Is this the bottom, or is it the final distribution before a $300 crash? I have my answer, and later, I will give you 3 exact trade plans: conservative, standard, and aggressive, with entries, stops, and targets you can execute today. But first, I need you to understand what is really driving this tape, because it is not what the headlines are telling you. I am Eric from Alpha Market Midan today. May 5, 2026, gold is in a tight consolidation regime, trading between 4,500 and 4,660, but the underlying structure is still bearish until we reclaim 4,660 on a daily close. I am treating 4,589 as the intraday bull or bear line. Above it, we test 4,656. Below it, we shove back into 4,530 and then 4,500. The pattern on the 1 hour is a messy descending channel with a potential high-low forming. On the 4 hour, every rally is still sold into unless we see a MACD positive cross, which hasn't happened yet. Pull up your 60-minute chart. Right at 4,589, you have a horizontal demand zone floor that has been tested 4 times in the last 72 hours and held every time. Above that, the 5-minute and 15-minute RSI curled north out of oversold territory, printing a minor bullish divergence that drove this last micro spike from 4,515 to 4,523. That is the tactical strength. But if you widen to the 4-hour picture, the story changes. The RSI sits near 36, not oversold enough to force a massive squeeze, and the MACD histogram is still printing red bars below the signal line, which tells me that the aggressive selling that started in mid-April has not yet run out of ammunition. The moving averages are stacked bearishly. The MA5, which you just saw dipping below 4,600, crossed under the MA10, and both are still comfortably below the MA20 and MA50. On the daily time frame, we have the 200-day moving average way down near 4,258, which is a longer-term magnet if this sell-off extends. For this week, immediate resistance is the MA10 zone at 4,5864,615. Above that, 4,656 is the neckline of the recent breakdown, and then 4,695 is the structural pivot that must break for bulls to regain control. On the downside, the floor at 4,5004,510 is the last line of defense before we accelerate towards the late March lows at 4,1004,350. Let me explain why we are here. The Federal Reserve last month voted 8-4 to keep rates at 3.53.75%, a rare split that sent a clear hawkish message. No rate cut in 2026, maybe not even in 2027. Markets heard that and immediately pushed the 10-year yield above 4.4%. That has raised the opportunity cost of holding gold so much that US-listed physically backed gold ETFs recorded their largest monthly outflow in history in March, 85 metric tons, $12 billion, effectively erasing the entire first quarter inflows. That is the flow that broke the back of the April rally. On top of that, we have had a bizarre safe haven paradox. The Middle East conflict in the Strait of Hormuz should have driven gold through the roof, but instead, the spike in oil prices past $111 a barrel fed inflation anxiety, which reinforced the Fed's hawkish stance, which then strengthened the dollar, and a strong dollar crushed gold, even as missiles flew. HSBC even came out and said gold has started to behave like a risk asset in 2026, not a safe haven, because leveraged speculators now dominate the futures market. And right now, the Middle East picture is blurry. Iran submitted a 14-point proposal. Trump called the talks productive, but Tehran also said the strait stays closed. So the market is pricing out the geopolitical premium while keeping the inflation via oil channel intact, a toxic mix for gold. But here is the subtle point. Yesterday, the dollar index pulled back from the 99.00 handle, and gold bounced from 4,500 with force. That tells me the market is still reacting to the dollar, not to the war headlines. For the next 2 weeks, I think the range will hold between 4,450 and 4,720, with a marginal downside bias, unless the ISM Services PMI today or Friday's non-farm payroll shock us. A very weak NFP number could give us a temporary squeeze toward 4,800. A blowout NFP could send us below 4,400. The moment the 4,500 level closes on a daily candle basis, I would flip short aggressively. Now, let's move to the section that pays your bills. Most traders see this. Bounce and immediately buy. But I want to show you something in the volume profile that tells me this bounce is still low conviction. The heaviest volume node in the last 48 hours sits at 4,580, not at the lows. That means real liquidity is building above us, and until we chew through that, dips will remain fragile. Strategy 1. Conservative, the confirmed breakback play. Wait for a 1-hour candle to close above 4,615, and ideally also above the MA10 on the 1 hour. That would signal genuine short squeeze initiation. Enter long at 4,618 with a stop at 4,585, just below today's low. Your first target is 4,656. Second target is 4,695. Risk to reward here is roughly 1 to 2.5. This play fails if the very next candle reverses below 4,600. Strategy 2. Standard. Sell the resistance rip. Majority of you are looking for this. Wait for price to rally into the 4,6564-660 zone and stall, ideally with a pin bar or a double top on the 15-minute chart. Trigger a short at 4,650 with a stop above the high at 4,668. First target is 4,589, which is the demand floor, and second target is 4,520 just above the critical 4,500 zone. Once price hits the first target, move your stop to break even. This is the highest probability trade given the prevailing trend. Strategy 3. Aggressive, the tactical fade of today's low, only for pro accounts. If price tags 4,5054-510 and the 5-minute RSI drops below 25, look for a bullish engulfing pattern to enter long with a very tight $10 stop at 4,495. Your target is a fast $2,530 scalp into 4,5404-550. Do not hold this through today's US ISM release. You are basically betting that the 4,500 floor holds exactly today, and you must respect the stop because if 4,500 breaks, the next level is 4,350. Before you execute any of these, I need to remind you, never risk more than 1 to 2% of your total capital on a single trade. Every stop loss we discussed is designed to give the trade room to breathe while protecting your account from a catastrophic event. A stop loss is not a sign you were wrong. It is a mathematical tool that keeps you in the game for the next high probability setup. If the US ISM print or NFP is about to hit, either flatten your position or reduce size heavily. Do not gamble your account on news volatility, trade the reaction, not the number. So, summarizing today's puzzle piece box, gold is trapped between 4,500 and 4,660. The trend is bearish, but the dollar hiccup and the solid 4,500 defense are giving bulls a micro window. The line in the sand is 4,589. Hold above, and we claw back 4,656 area. Lose it, and the 4,500 acid test is coming. Tomorrow, all eyes will be on the US ISM Services PMI. A print below 50 will likely force a short squeeze, while a print above 52 will accelerate the bearish flow. After that, the big one, Friday's non-farm payrolls. Now I want to know, where do you draw your line? Are you buying this dip at 4,500? Or are you waiting for a clean breakdown to 4,350? Put your bullish or bearish line, and your target price, in the comments below. I read every single one. Make sure you leave a like, subscribe if you want 8 precision asset breakdowns every trading day, and hit the bell icon so you never miss the NFP trade plan this Friday. My name is your name. This is channel name. Keep your analysis sharp and your risk tighter. See you in the next one.